The Fed's favorite inflation gauge showing prices rose at a 3.2% annual rate in November, just below what economists expected. Headline PCE was up 2.6% from a year ago, but actually fell a tenth on a monthly basis, the first monthly decline since April 2020. As inflation fears ease, my next guest sees 3 rate cuts ahead next year. Tom Porcelli, PGIM chief economist, welcome. Also with me, CNBC's very own Steve Liesman. So, Tom, sluggish growth you expect in 2024. How does that factor in?
We do. So, this I think is the thing that I think we need to sort of start to get our heads around a little bit because, yeah, you probably avoid a recession. Again, I think it'll be close, and I think there's some risks out there that are certainly worth talking about. But if our base case of weak growth materializes, so call it around 1% growth, for the reality is for some people that's going to feel pretty recessionary. And then I think about, okay, well, then what's the catalyst to really sort of get you out of that? We're going into an election year. Congress is split. It's going to really be hard to sort of find some fiscal stimulus to get us out. So I really see more of a sort of a slog for the next year, maybe 2. I do think that there's a catalyst out there waiting for us. That's productivity. And I've said many times on here and elsewhere that I think that, the pieces are in place for productivity to sort of perform really well. But that takes time to develop. So I think for the next year or so, I think things could feel pretty soft.
Things feeling soft, though, Steve, could actually be pretty good based on what people have been expecting. I mean, this PCE number, could it have been better?
No, I don't think so. But, what Tom is saying has a lot of truth to it, which is the following, that an economy that grows below potential does mean pain for people out there. If the pie is not as big as it should be or could be, then some people are going to be getting a little bit less. I will just challenge the general thesis for today, which is that we do see with the data we had today, the durable goods data, and some other data that we've had, the personal income and spending numbers, people are revising up the fourth quarter forecast. I know that's what Tom's not talking about, but it's just worth putting in there. I've seen a forecast for the fourth quarter, which was supposed to be, again, the slowdown from the torrid third quarter, which was near 5%. Now we're looking at 2-3 versus somewhere between 2-3 and 3%. Still early days, still a lot of data to come, John. But the point is that is an economy that's going at or above potential. And the only thing that I completely get what Tom's talking about, the idea that there will be some biting that has to do with the Fed raising rates, companies needing to refinance, some softening in the labor market. But this slowdown is below potential slowdown has been predicted for a long time, and it has not been the right call, at least all of this year.
So Steve mentions pain. That sounds different to me, though, from the kind of pain that Powell was talking about a few quarters ago that freaked the market out. I mean, not to diminish anybody's pain,
right?
But it's different, right?
Yeah, definitely. I mean, look, the unemployment rate is going to rise in the coming year. In fact, the unemployment rate's rising now. It's rising very slowly. But over the coming year, it's funny. I think people forget because I think they're using jobless claims, and I think they're saying, "Hey, jobless claims remain really low," and I think that's fair. They obviously do. But continuing claims are actually up. And I think more practically speaking, if you just look at the number of unemployed, right, like the number of unemployed from the payroll report, it's basically been rising since April. And if you look at the relationship between that and continuing claims, it works really well. And so if I take a step back, knowing that, if I look at the change in jobs over the course of the last few months, and if you strip out healthcare, and I think there's an important reason why you strip out healthcare, because healthcare is not cyclical, right? That's more secular. So if you strip out healthcare, what you see is that we've been gaining jobs at about last month we grew 10,000 jobs. 10,000 jobs last month, ex-healthcare, and of course adjusting for the strikes. Over the last few months, we're only gaining around 50,000 jobs right now. What's interesting about that is you think about the standard error on that report. The standard error is like 100,000. So you're now within the standard error, meaning you could see a negative. And I think for all those people that are looking for March cuts, which I think is very early, I think that's what it would take. I mean, I think you need a negative or something really close to that for the Fed to start cutting in March, which, again, I think is wildly premature. We do expect 3 cuts, as you teased at the start. But, we don't expect that to start until Q2.